There's always someone out there that wants to predict the next market crash. They watch The Big Short and they want to be one of the heroes. Investors read the article, they click on the video, and their mind starts to race. They want to get investors scared. They're feeding people BS and they want you to eat it up. Their fear-mongering is a huge reason why so many savings plans get buckled. The easiest way to sound smart is to be pessimistic. Point at a problem, predict a disaster, and tell people why this time is going to be different. Geopolitics are at hand, volatility is here to stay. The good old days of the Cold War are a thing of the past. If I gave you 5 reasons to be optimistic and 5 reasons to be worried, chances are you'd spend more time thinking about the things that make you worry. That's human nature. Nobel Prize-winning psychologists Daniel Kahneman and Amos Tversky spent decades studying this and how people make decisions. One of their key findings was that people tend to feel losses a lot more intensely than gains. Fear grabs our attention. It gets clicks, it feels important, and for our ancestors in the jungle, fear kept us alive. That's why market crash content and headlines grip our eyeballs. And that's probably why we don't see the market will probably be fine, just chill, on the news. Meet the financial doomsdayer. He predicted a crash in 2016, then again in 2017, then again in 18 and 19, and pretty much crash every year since. He only needs to be right once to be able to say, see, told you so. The other times he'll deflect and say he was right, but just too early. It's on the way. But your retirement needs him to be right every time. So let's talk about the doomsdayer and what they're really saying. 1.18% of Canadian mutual funds, those managed by professionals, highly educated people with access to vast data sets and information that you and I will never have. Only 1.18% managed to outperform the TSX over the last 10 years. Dismal results. Now factor in that these 1.18% are no more likely to outperform in the future. That means identifying future outperformers is essentially random chance. The doomsdayer is telling you implicitly, screw the research, screw the odds stacked up against me. I'm David, the consensus is Goliath, I'm gonna win. This obviously ignores that you're far, far more likely to be one of the countless victims of Goliath prior to that big battle. But go on, doomsdayer, tell me more. Because every doomsday prediction should come with one simple question to follow up. Okay, and then what? Sell everything? Great. Then what? Sit on cash? Okay. Then what? Buy back in? When? Under what conditions? How will you know? This is where their whole story falls apart. Because selling isn't a strategy, it's only half the strategy. And that's where things get hard. Let's say the market falls 20%, maybe even 30%, maybe 40%. Let's give them the benefit of the doubt and let's say they were right. You protected yourself. You moved to cash. Congratulations. But now what? Do you wait for inflation to come down? Do you wait for interest rates to fall? Do you wait for unemployment to improve? Do you wait for some signal that'll say, now it's a safe time to get back in? And is the doomsdayer going to be the one that's going to be there to say it? Here's the problem. Markets don't wait for you to feel better. Markets move on new information, not known information. By the time everyone agrees that things are getting better, prices have usually already moved. Economists call this the efficient market hypothesis. It's the fancy academic version that says millions of investors are constantly processing new information and adjusting prices. The practical version is simpler. The headline you read about, that you're worried about, everyone else knows about it too. Now here's where the doomsdayer gets an unfair advantage. Every year the markets go down. Every single year. Since 1980, the average intra-year decline in the S&P 500 has been 14%. 14%, that's the average, it's not the worst. It's the average. Yet, most years still finish positive, which means every year the doomsdayer is going to have something to point at. The market falls, the headlines get ugly, and they get to say, see, I told you so, regardless of whether the reasons for the fall were any of the reasons they give. Likely not. But that's not really the question investors should be asking. The question isn't, were they right that the markets fell? The questions are, what happened after? Were you any better off? And is this a repeatable process? So let's go back to our initial question, asking, and then what? Because this is where things get expensive. This chart from Invesco shows the impact of missing the best days of the market over the last 30 years. If you stayed fully invested, you earned roughly 10% annually from the S&P 500. An incredible result, despite the dot-com crash, despite the global financial crisis, despite the lost decade of the S&P 500, despite COVID, and despite every scary headline that we've already forgotten about. Now look what happens when you miss just the best 10 days. Not the best 10 months, not the best 10 years, just 10 days over the last 30 years. That's one day every 3 years. $1 million disappears from an initial investment of $100,000. Gone. Simply for missing out on those 10 days. And here's what the doomsdayer doesn't tell you. Those 10 days don't show up after everything feels fixed. They don't arrive after headlines go from good to slightly better. They arrive when people are still terrified. They arrive when economists are still debating. They arrive when people feel less confident about the future. And that's the trap. Markets typically recover long before people's emotions do. They arrive probably when the Doomsdayer is screaming that things are only going to get worse. And that's why timing the market is so difficult, and that strategy falls apart. Remember, the investor doesn't need to be right once, they need to be right twice. The Doomsdayer says, get out? Fine. But when exactly are they telling you to get back in? Because missing just a handful of those recovery days can cost you far more than the decline that you're trying to avoid. I've been an investor since 2013. I still get nervous. I still read the headlines, and I still wonder whether this time might be different. I have kids. I have a business. I have financial goals. I'm not immune to fear. The difference isn't that successful investors don't feel fear. They follow a financial plan, they implement it, and they use an evidence-based approach. Very few investment professionals outperform the market. There's no way to predict future outperformers. And the markets move fast, and sitting on cash hoping to get back in is a recipe for disaster. The Doomsdayers want you to believe that they're protecting you from uncertainty. In a diversified portfolio, decisions around how we implement a strategy, our investment behavior, is far more important than the actual investments themselves. Notice in this image, courtesy of Carl Richards, great behavior is a much larger circle than good investments. I think he's right with this. The easiest way to sound smart is to be pessimistic. The easiest thing in the world to tell people is that they should worry. The Doomsdayer wants you to forget that at every point in the past, there's been reasons to worry. It hasn't been all rainbows and unicorns. There's not going to be some endpoint volatility that we can point to and say, now we're back on track to the good old days, because they never existed. Being right for the right reasons over the long term means that we have to be willing and embrace being wrong for the right reasons over several incremental short terms. Because investing isn't about predicting the future. It's about building a plan that works even when the future surprises us. Put those two together and you're on your way to making smart decisions and making your money grow. Thanks for watching.